it's Aaron again. Just wanted to do a quick video this morning. A couple of questions that have been coming up recently in relationship to interest rates, inflation, and the price of housing. So I wanted to pull these statistics for you and show you just generally a couple of things in relationship to that. So I have two different graphs. One is interest rates over the last, let's call it 40 years, and even further back than that. Actually, the statistics go further back than that, but I'm going to talk you through these and show you both interest rates and then the average price of housing in the United States. I think it's pretty fascinating to look at it. A lot of people say, hey boy, when interest rates go up, house pricing comes down. And while that's true generally for small windows, it's not necessarily like there's this major crash in relationship to that. So this correlation is pretty interesting. I've been getting this question a lot as people are saying, should I wait? Should I buy a house later? What should I do? It looks like interest rates are creeping up, so it seems like there might be some value to just waiting and seeing when the market kind of when a recession might hit. There might be some values in the market. While that might sound in theory correct, the statistics don't necessarily prove that out. So I want to go through these with you, show you what they look like, show you how this actually works, and I think it's a pretty fascinating exercise to make that analysis. So here are these charts. We'll go through them, give you a good chance to understand what's happening with them, and then we'll talk about a little bit further about it on the other side.
Okay, these are statistics from Freddie Mac. You'll see the interest rates on the left-hand side ranging from 2.5% to 20%. All of the vertical gray bars end up being recessions along the way. So we start this back in 1972. We move our way through 2020. You'll see some of these larger recession areas. 1982 is one where interest rates went all the way up to 18%. Since that moment, interest rates have been on a precipitous decline all the way to our current state in 2020, which went all the way down to 2.5%. That bottom gray horizontal line is a 5% interest rate. So you're going to see after this Great Recession here, which happens in 2008, you're going to see the interest rates stay right around 5% and have for the last 15 years, basically, to give us this 2.5% to 3% interest rate on a 30-year fixed mortgage. So you're going to notice that the interest rates continue to drive down, and everywhere along the way that these recessions happen, you'll see that the Fed's reaction is to drop those interest rates and see if they can stimulate the economy by doing so. Okay, our next chart is going to also come from Freddie Mac. You're going to see this is the price of housing in dollars. So on the left-hand side, we go from $40,000 up to $440,000. We start in the same year, and the gray bars indicate the recessions as well. They're going to match up with the ones that were on the last chart. So what you'll see is as we go through these recessions, you'll see little dips, but pretty quickly coming out of those recessions, housing is right back to where it was. This big bar here in the end here, which starts in 2008, this is the biggest housing crisis in the history of the United States. In about 2007, we get to a peak of about $265,000 as the average sales price. We dip down to the lowest portion in there in about $225,000. And then what you'll notice is that by about 2013, you're back to what was in 2007. So within a 7-year window, you were back to the pricing that was originally there. That is the greatest dip in all of housing history in the United States, and you'll notice that within a 7-year window, you've recovered that asset. We get all the way to the end here, and you're going to notice a giant spike starting after the 2020 COVID recession, and we're all the way up to $410,000 as an average in the United States.
So as you can see, those little gray bars and those recessions that are in there, some are longer lasting than others, and if you go in and kind of dial in on it, you can see certainly some areas where you get small little dips, but the overall trend line in real estate tends to be higher. And that's because what we've talked about in the past with money and inflation, the relationship to how much money actually ends up getting printed and how much money ends up actually being a part of the system. Housing ends up being this kind of interesting hedge against inflation, because even though we might say, well, we're looking for a deal, over the course and trend line of things, it doesn't seem to end up being like that. And that has a whole lot to do with tangible asset relationships to interest rates and inflation, more than it has anything to do with recessions or the spike in interest rates. Really, the spike in interest rates don't do much but exacerbate the recession. Everything else in there, as you can see, is really more of a relationship to the price of housing continues to go up because the value of your dollar continues to be diminished. We talked about that last time. The purchasing power of the dollar is down almost 1,200% since the Federal Reserve started its process in the 1900s, in the early 1900s. And so that you can really see that where housing ends up kind of becoming this nice hedge against inflation And pricing and interest rates have very little correlation to do with one another. So I know that sounds really counterintuitive. Seems like something that might not make a ton of sense in relationship to what we've always been told or heard, that when a recession happens, house pricing comes down. Anecdotally, that might be true for small windows, but over time, over the course of time, housing becomes a pretty great investment. So thanks for listening, and I hope you enjoyed this, and that it's helpful, a little bit of a kind of an indicator of how things might be going. And if you're waiting to buy housing, or if you're trying to get into the market, this may help you make some assessments and valuation about whether this is a good time or not.